Yeah, it's really a confirmation of kind of what we've been thinking is largely the counter trend rally off the October lows was largely over, and that the seasonally strong December period that a lot of people were citing and looking for was a much different setup this year, because as you recall, we've been highlighting when the S&P is down 15% or more through the end of November, the average December returns back to 1929 have actually been negative 2.16%. So it's a much different setup this year. We think it's kind of following the more bear market style playbook as opposed to the typical seasonal strength that you see in November, which is really, in December, which is really just a function of the fact that markets more often than not are up, and it's just a continuation of that momentum. So different setup.
Different setup. Seasonalities up against a pretty big wall, clearly. So what would have to happen in your mind for a year-end rally to materialize? Something unforeseen and dramatic?
Yeah, I mean, I think the issue is you're running out of shot clock here, right? You said 10 days left, and the upside catalyst in our view was this week. So could you get a little bit of bounce or consolidation? Sure, but I think there's an equally, if not better, chance of a continuation to the downside. Again, I'd say two key areas stood out for us the last couple of days. On the sector level, industrials, they were the best performing sector off the October lows, and they put in a bit of a false breakout in the last couple of days and have really broken to the downside. And then semiconductors, if you take it a step below sector level at the industry group level, semis were the best performing industry group over off the October lows. And similarly, they tried to break out above the 200-day consolidation and kind of failed. So, again, we think the opportunity for that year-end rally was probably this week, and it doesn't look like it's, at least in a big way, going to materialize.
So what levels then, if we're not going up, do we need to watch going down?
Yeah, I mean, short term, the 50-day on the S&P is around 38.60. I don't know that that's going to be a huge support area, but certainly there'll be some people watching it. And then it kind of gets messy. There was just a lot of choppy trading action between the lows at 3,500 and kind of the 3,800 level. But from our perspective, it's not so much any one given level. It's kind of a weight of the evidence approach. And I think the biggest change over the last couple of weeks has been the breakdown in the correlation between bonds and stocks. We know that most of this year, bonds and stocks were pretty highly correlated. Over the last couple of weeks, that's shifted, and I think that's because the market is shifting its focus from inflation and the Fed narrative to potentially the economy narrative. And you notice that today with bond yields down big and stocks down big. So that's really the focus.
I was going to ask you
going in. Yeah.
Sorry to interrupt you. Lastly, though, I was literally going to ask you at that moment when you were saying that. So if yields keep falling, it's no longer a positive for stocks, is what you're suggesting. It becomes more of a negative because of worries about recession.
Yeah, I think that's right. We've been kind of highlighting the 3.5% level in the 10-year yield. We actually thought that it would hold, but we thought that if it didn't, it would be because of those fears and therefore probably more of a risk-off sign. I think that's what you're starting to see, the last couple of weeks.
Jonathan, we'll leave it there. I appreciate your time very much. That's Jonathan Krinsky, BTIG's Chief Market Technician.